Hello and welcome to this webinar on volatility trading. This is a special webinar. We are hosting today Kranti from India. He's right now in India. He's anybody who has had a chance to speak to him knows his subject matter expertise on this topic. So we are very excited to host him today. And I'm sure all of you guys are going to have a good time, a great time when I hand it over to Kranti bhai. Before we get started, just a few points for the administration of this for rest of this call. So I see a lot of you have joined on the Zoom, so welcome here. This is an opportunity for you to be able to interact directly with Kranti bhai. But during the course of the presentation, I would request you to keep your videos and audios on mute. Do not turn them on. It might distract the speaker. There is a chat in the room, so feel free to point your questions in the chat, and then I'll be taking them on. I'll be taking the questions on as and when needed, or as and when it's suitable. For those of you who are watching us on YouTube, keep in mind there's going to be a few seconds lag, about 15 to 20 seconds between what we speak in our live room and what goes out onto the YouTube channel. But you can also write questions and comments on the YouTube live stream. There's a chat available there. So, I'll be reading those questions. I'll be making sure that we get the best out of it. I'm very excited to learn. This volatility trading as a topic is very well spoken about in a global sense, but in Indian market space, there are a handful of practitioners who can do it well, and a further less amount of people who can talk about it as well as Kranti can, right? So I want you guys to extend your warm welcome to all of you, to extend a warm welcome to Kranti. What we'll do is I'll hand it over to him now. He'll be sharing his screen, talking a bit about your background, his background, and then we'll go on. So welcome Kranti bhai. Welcome to this webinar. We are very excited to have you.
Thanks, Ankit. That introduction video was pretty good, huh? Disable capital.
little things you have to do. Little things you have to do in the
Yeah,
business. Great,
yeah,
great. So, Kranti, bhai, why don't you get started? Maybe it'll be a lot of audience might not have had a chance to speak to you earlier. It'll be very useful if we start with a bit of your background, and then you can go into the topic, free form. Let me know if anything I can do to help.
sure.
Over to you.
Yeah. By the way, I have a little cough, so I'll probably keep muting in between whenever I get it. So please bear with me on that. Um, right. So I sort of moved back to India last year. I am um, Kranti. I did my BTech at IIT Kanpur in graduated in 2004, and then I was working as a software engineer for the first 3 years, and then moved into um, the finance area around 2007. And since then, the first time I got acquainted to derivatives was in 2007. And then it was sort of working as a desk assistant with Credit Suisse. I was working for the Equity Exotic trading desk there, assisting them as a desk assistant. It was nothing fancy in terms of the job, but I came to know about different exotic structures at the time and different. Hello, sorry. Different exotic structures and different pricing models in equities at the time. I wasn't a quant, but I sort of gained a lot of. I had a huge interest in trying to learn about pricing models across asset classes. So I was working from Mumbai, and then I moved to London in 2010. I did different jobs. I first worked as a quant in counterparty risk, and then quant in market risk, coming up with bar models, and finally moved into front office or the front office quant with Citi. Uh, Initially, for the first 1 year, started out with interest rates, linear interest rates, the swaps, bonds, the linear stuff. And then from second year, started moving into exotics. So my job was to price exotic interest rate derivatives. These are typically swaps, but these are like cancelable. You can cancel them anytime, and the fixed rate on the swap is linked to any of the rate indices like your spreads, etc., etc. So that's how it becomes exotics. Pricing them can be quite a challenge if you compare it with the equity world. It is challenging because each swap will have multiple. So when you can cancel a swap at any time, you actually are exposed to multiple swaps inside this, let's say, 10-year swap. So you have like different factors. It's like multi-factor that you need to model. Whereas in equity, if you're pricing some exotic on, let's say, S&P 500, it's typically the underlying and also the volatility. It's just two factors that you need to model. So that's basically my background. I started full-time trading since last year. June is when I started trading full-time. So I mostly trade in stocks, stock options. I traded in weekly options as well on Nifty and Bank Nifty to begin with. Um, Eventually, I realized that the noise that you get trading weekly options is unless you're doing it in an automated way. I felt that is manually doing weekly options was for me at least was too much of it was pretty hard to manage the noise. So I started doing monthly expiries in indices. For example, if we are now, so I trade, for example, in April. So yeah, I mean, the most of the stuff that I trade is single stock options, and then monthly options within indices. So yeah, I mean, this is a little half a start, but yeah, so that's my background, and this is what I've been doing now. So
Great. Thank you for that. And I know exotic interest rate derivatives is a very complex field. So maybe today's call, or maybe when you get time during the time, you can draw on some of the learnings from that market that can be applied, right? So, but thank you for that, for your introduction.
right, so I think I'll just continue, right? So basically, what I would suggest before starting this, right? I think whoever trades in vol, so when I say vol trading, usually you try to keep your exposure to the directional bit as low as possible. So you typically tend to have delta neutral positions, delta close to zero. That's what you try to keep, and then you try to trade on the wall. I mean, if you see in terms of returns of any stock or any index, the expected value of the stock, for example, someone trading in direction, he would have a view on where the, let's say, the future is expected to be in, let's say, 1 day's time. So that's like the first moment expected value. And if you call it as E of, X, X is the return, you're just estimating what the return will be on the future, like 1 day from now. That's first moment. I think forecasting the direction of anything, the stock or future index, whatever, I think it's extremely hard. Although I think there are ways to sort of do it at a very low time frame, which probably I'm not going to talk about that in this webinar. But I personally think that forecasting anything for a longer time frame of even like anything more than 1 day is extremely hard. That's your first moment. When you come to volatility, that's like the second moment. So X is the return, so expected value of X squared. That's your variance, and then you have X cubed, that is Q, and X power 4 is the kurtosis. So anything as you go higher, I think it becomes more easy in terms of getting your bets right in terms of forecasting, for example. So yeah, so ball is something from what I have done till now, I'm fairly comfortable with in terms of forecasting ball. um, so that's what I'm doing. I think anyone who trades vol should have an Excel sheet. I mean, there's something I very strongly think that everyone should sort of build an Excel sheet, right? I'll sort of give you an example of what I have built, sort of. I mean, and that Excel sheet should have like basic functions, like let's say your Black-Scholes formula. It should have the implied wall formula. It should have the delta, vega, um, gamma, these sort of basic functions. And then in this Excel sheet, you can do a lot of analysis. So if you want to check what is the gamma profile of you know straddle or triangle as things keep moving, as a spot keeps moving, you can do whatever you want if you have these few functions written in VBA, for example, in your Excel sheet. You might be seeing on Twitter people talk about Vanna, charm, etc., which might look very complicated. But if you build this sheet and you try to sort of do some sort of scenario analysis where you keep bumping spot, you check how the delta is moving, you keep bumping spot and check how the vega is moving, you will understand a lot of things about behavior of options in terms of weeks. Um, and you also get a feel about how these things move, and whatever people share on Twitter, etc., will look much more relevant. I think so. I'll strongly recommend anyone who wants to trade in vol or who's already trading vol to sort of have a sheet which can do these operations. I'll sort of show a snapshot of the sheet that I use later on. So you can see my screen, right, Ankit? The
Yes,
presentation, right?
yes. The screen is very easily visible
Yeah,
in the Zoom
right.
and on the YouTube, so we're good.
Yeah. So the ones which I trade mostly is single stock options and skews, and when there are events like earnings uh, and also some Fed events, I trade those as well. I so when it comes to stocks, I always get into straddle. So even at the beginning of the month, so for example, we are now at the beginning of the month, right? I first every day, as soon as it is, yeah, when I get into the office, I run a sheet which computes the realized vol. The realized vol that I compute is based on what Ewan Sinclair has in his book, Vol Trading. I think the chapter's name is, I think, Vol Parameterization. I think it has 5 different measures. I can actually show an example of the sheet now. Uh, actually, a sec. Okay. This is the realized what that I calculate. Actually, I wanted to show another sheet. One sec. Right. 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 So every day I generate this sheet, and it has like the close to close wall, Parkinson's wall, all these 5, and I just average them out. I mean, ideally, I just average them out, but I think you can also assign different weights. Maybe you can just not take close to close wall at all. Maybe just put weights on these 3, for example. It's up to you. I mean, I'm still sort of researching that side of things, which ones are more relevant for the length of. So I usually carry it for roughly 2 to 3 days. I also do intraday. So depending on that, whichever measure, that's the analysis that I still need to do, which measure is probably more useful. I'll also quickly share the code, because I after my Jainam talk, there have been many people who, asking me about this particular. So this basically, so I have started taking 25 calendar days. It's not business days. That's because typically I'm not going to keep changing the number of days. Oh, this is the number of days over which I'll calculate the realized work, 25 days. Because the length, the expiry of the options is less than, like, starts from 30 days and then keeps on till expiry, right? So I just thought this is probably the best number of days I'm going to take the data from. But you can, initially I used to use 30, and then I compute all these, as I said, depending on based on what Ewan Sinclair had in his book. So I run the script and I get the output that I just showed. Maybe actually, let me just share the screen. I think hopping on between these is going to be a pain, right? Right. So this is what I calculate, right? So, okay. So I compute this realized wall, right?
Kranti bhai, take a couple of questions if you don't mind.
Right.
So question is ki jo calculations you were showing, is there
Right.
a root mean square, or basically are you averaging the variance and then taking a square root, or are you calculating the volatility as a square root and then assigning weights, or averaging them after the square root of individual estimate?
Square root. So each one, at the output from each function is a square, is a wall measure. It's not a variance. So if you see everything is basically, yeah. So the output of these is square root of whatever has been proposed, and then, yeah, I just take a weighted average of. I mean, I have given this as an input, but for now I just use it 0.2 for each of the different measures. So it's basically a simple average. And I get this file. I get this file, and so Nifty, Bank Nifty, for all the stocks, right? Even for Fin Nifty, everything I have this, and then I run the other file, which this generates this particular file, which has all the information. So I generate my own IVs. So I pick up at any point of time when I run this, I pick up whatever option prices there are at the money, and I compute my ATM IV, and I pick up the realized vol from that file that I just calculated, and I compute this the VRP. The VRP ideally is defined as IV minus RV, but I use IV over RV, so it's like a ratio. And I sort it out based on this ratio. So let's say I do this. I sort it from largest to smallest, and whichever is the highest. So I also look at the bid-ask spread as well. So I mean, you can see that here the bid-ask spread is pretty bad. So I mean, this is something you can't really enter. So I only look at the ones which are liquid, and whichever have the highest ratios, which are liquid. I think some of them, the script, I think there is a bug. There's probably an issue with the script where you see that this very clearly looks like, the ATM call is much higher than the put. So probably there is some issue with the strikes. So I pick up the ones which are at the money, and the ratio is anything at the beginning of the month. I check anything which is more than 1.2 and sell all the straddles over this value. So this how I enter short straddles. I do not buy any hedge at the end. So I don't do an iron condor. I don't buy strangles, OTM strangles. I just sell the straddle. And now the question might be like, what happens if the market crashes, right? So I have a market risk hedge where I get into back spreads, put back spreads on Nifty. So for example, today this March, right? So June, September, I enter, let's say 15,000 strikes, long puts. For example, if you're going long 10 lots, then I'll short 2 lots or 3 lots of 1,600 put. So it's like a back spread. So it's a long ball trade. And if a crash were to happen, that back spread is going to gain in value because of the ball, which is a long ball trade. And also it's going to be a short delta as well. So that's how I hedge my market risk when I sort of short these straddles. For now, I do not buy any hedge on the upside. So you can say that maybe there's some sort of corporate tax cut news that can come in, where everything goes mental upside, and I don't hedge. So right now I don't do that, but you can potentially also buy a back spread on the call back spread on the higher side, but it would be better to make it as close to zero cost, because you don't really want to the number of times those events happen is less frequent compared to market crashes. So probably you don't want to waste your money buying call back spreads, paying premium. So this is how I do as far as stock straddles are concerned. Now,
can we ask a
right?
couple of questions?
Yeah, sure.
From the audience and myself. So one question from the audience has been on YouTube that for IV, do you use Black-Scholes or Black 76 formula?
Is Black 76 formula the one where you have your normal formula? Is it? Is it a normal formula?
Yeah. So Black 76
Where
is,
you,
I think, where you use the underlying futures with the interest rate being zero. And Black-Scholes is, I think, where the normalized and
so you have two versions, right? One is like you assume the underlying as log normal. The other one you assume it is a normal. Okay. When the Black 76 is the normal version. No, absolutely not. So the normal version. Okay. Let me take like a couple of minutes on this, right? This quant and all. So for stocks, FX, right? Even interest rates. We use the modeling of the rates is usually log normal. Hmm? When it comes to rates, we have something called, so like you have options on Nifty and Bank Nifty, you also have options on swaps, they're called swaptions. Now, all those options are quoted on normal walls. When you say normal walls, you're assuming swaps to be moving just as a normally distributed, not log normal distributed. And then the options are quoted as normal walls. But when we sort of do the pricing, when I used to like work City and all, log normal is what you typically use. Now, especially with the rates in the US on the higher side compared to 2 years ago, they were sub 1%. Now they're like 4%. Log normal walls is the right distribution to be used. Obviously, when I say log normal, don't assume I'm saying blacks. We actually use something called a saber model, which has fat tails and skewed distribution. So let's not get into it. But when I say log normal, it means you look at the returns. The returns you model the returns rather than the rates itself. So when it comes to equity or FX, there is literally no question. You always have to use log normal. I mean, the normal doesn't even come into picture. Okay.
Right. I think the Black 76 and the difference is key whether you're using underlying as a futures or you're using underlying cash stock price when you're calculating these IVs.
Okay. So it's not the normal version.
That was all
Okay.
useful, beautiful.
Hmm.
But for the
No, I use
essential
futures. I use futures.
futures, okay, that's
Yeah, I
that's the
use
question.
futures. Yeah.
One question from my side.
So I mean,
So
can people see this thing, right?
yes, yes,
So
we can see the screen.
I take the future and then yeah I take the future.
Yeah. So one of the question I had was, so you talked about hedging the downside, which is
Hmm.
most likely due to the fact that spot vol correlation. So spot goes down, the vol goes up, so that correlation, that's why you're hedging the downside. One question that I had was, let's say you are trading these portfolio straddles, right? You're trading them on 5, 8, 10 names, and then you're hedging them with some nifty back spreads. So what kind of sizing do you do? If you can talk about, is it related to some beta measures? Are you doing, let's say, a notional sizing? Assuming, let's say, you traded 5 short straddles on stocks, how would the size of your hedge on the back spreads on Nifty would be affected, or how to think about that?
So I'll be honest on this one. I still don't do a very rigorous. I don't have a very rigorous approach to do this. So what I roughly do is I assume that if Nifty falls, if it hits a lower circuit, for example, I just do a scenario. Okay, I just do a scenario analysis. So by scenario analysis, I mean, so I told you that everyone should have this sheet, right? So in that particular sheet, just let's assume that Nifty does a low circuit. Um, so from 18,400 to whatever, right? So 16 200 whatever, and then bump the wall. Obviously, if it's going to slow circuit, the ball is certainly not going to be a 13%. It's going to be like 70% something. Um, I do that analysis, and I also assume all these stocks hit lower circuit, and the stocks uh, go up to 100%. I just assume everything goes up to 100% wall, and that's how I sort of I look at based on what I have right now in terms of the straddles, and then what the nifty back splits are going to get. So that's how I manage the size. So you can actually loosely say that it's based on position sizing. And I think generally speaking, the thing about this sheet that everyone should have, it's very good for scenario analysis. I think, see, I'll tell you something, right? So when I was a quant, right, everything has to be accurate. So my job as a quant is basically there are stuff that are not trading in the market. So there is some pension fund or hedge fund which wants to trade, let's say, some 15-year, $100 million notional swap. Now, there is no way for them to trade, go to some OTC market or exchange where they can know the price. They come to the banks, and banks have to tell them what price they have to, they would be prepared to sell them to. So there has to be someone who needs to compute the fair price. Yeah, the fair price. And it's us quants who build these models, which will tell our the marketing guys, the structuring guys, what the fair price is, and then they're going to add some fees on top of it, and that's what they're going to quote to the clients. That's the business. The exotic business completely this, right? So I have to be extremely accurate in terms of what risks I'm capturing in my model, um, what correlations, etc. Now, when I made this transition from quant to trading, right, it's a completely different game, right? Trading, being quantitative. So when you're trading options, being quantitative helps because options are not your like linear instruments where there's very little complexity. It helps, but there is much more to trading than just being quantity. You need to first, when you actually put a big position, the stuff, let's say Bank Nifty suddenly does this, on expiry date, does this green candle within like 5 minutes, 400 points, whatever, right? I mean, you can't really think very quantitatively, when so much of your you put on size and that's at risk. And I used to trade weekly options heavily before. So for me, my journey so far has been to understand the trading aspect of things, to look at, let's say, in terms of stock, the liquidity. A lot of stocks don't have the liquidity. How do the market makers try to play around with the bid ask spread? And I think most of you whoever would have traded in stocks, they would know that how the market makers try to play. Like as soon as you try to you want to sell something, and you, if especially if it is not a liquid stock, and you try to bring the price a little bit down, they're going to keep bringing it further down, right? And they'll probably also know that you're going to sell a straddle, that you're probably not just selling a naked option. So as soon as you hit this, the if you're selling the call, the put price, they will automatically bring it down as well. So understanding trading is much more complicated than knowing anything quantity. So most of my time has been to understand the market itself, and also you also have the understand the macroeconomic environment, how Fed doing something is going to affect your equity markets, how RBI doing something, or so there is so much more than thinking in terms of quant that one needs to go through when it actually trade. Now, obviously, once I get comfortable, I think I'm still learning, right? I think everyone is probably still learning. I'm still learning. And once I sort of get more and more comfortable with the trading aspect of things, I'll try to sort of make my system, whatever, more quantitative. So right now, I'm still in the process of understanding the dynamics of the markets, um, irrespective, I mean, setting aside the quant aspect of things. Um, So yeah, so I mean, as far as coming back to your question on how do you hedge your the Nifty, sort of how do you manage the positions? I do a very rough analysis as to how many puts that you need to buy um, to manage the stock portfolio. There is one more hedge that we can do. So you have this thing, right? So I said that sell the ones which have the highest so-called VRP, right? You can also go down and you can have like you can choose the ones which have a very low VRP. So in terms of IV minus RV, these are all negative. Anything less than one is negative, right? You can also choose to buy straddles on these, right? And these will become a natural hedge. This will also become a portfolio hedge. Um, so you have sold a bunch of, you have shorted a bunch of straddles about, let's say, 1.2, 1.3. Uh, you can sort of long some of the straddles which have a low VRP. Although my experience with long straddles has been pretty bad. I think long straddle is a completely different game. I think if you're trying to make profit out of long straddles, that's where I struggle personally massively, because I think long straddle is a more like a trend following game. You need to be extremely patient. You need to wait till the stock moves big in one direction, then either try to exit the straddle. But if you only want to use it as a hedge, it can be a very good hedge. And from my experience, the ones which are laptop, I mean, I speak to Gaurav Shekhawat. I think people probably know him on Twitter. El Torizon is probably even in this call now. So speaking to him, I mean, he also mentioned this something. So when you get into long straddles, it's good to focus only on the large cap stocks, not like your, for example, Intellect seems to be 0.83. You might want to buy straddle, but you also see that the IV of 31%, it might go down to 25%. So maybe some of the stocks which are pretty good to do a long vol on are typically Hindustan Unilever, HDFC, and you can choose some of the NTPC and some of the other large cap stocks. These something like Hindustan Unilever, it tends to realize more than what the walls implied, the options, I mean, the implied walls on the options. So you should, I mean, better not to get long wall on all the stocks which have a low VRP. Only choose the large cap stocks. So this can be a natural hedge for your short straddle portfolio. Hmm? And if you're going to take these, then you can reduce your Nifty back spread exposure as well. So yeah, I mean, also it's not just the VRP. I look at also sometimes, even if the VRP is low on some of the stocks, the IV itself might be, so this is the IV, right? So the IV itself might be high. For example, India Bulls, I mean, this is the one which I always keep realizing a lot, 43%. And if I see that the IV has increased from one day to the next, which I also save it here, right? Yeah, so it's basically, yeah. So I then see, okay, the IV has increased and I look at the ratio and then I decide. So it's not just solely based on VRP that I decide what to do. So this is as far as how I sort of choose what to enter. Now, coming to, so what happens after enter, right? So how do I adjust the positions? Now, so when I even when I start putting positions, right? I always put like one lot at a time, because I take multiple positions in stocks. I usually enter 2 to 3 lots. Sometimes when it's an Adani and Adani goes complete mental, I enter even 4 or 5 lots, even 6 lots. But one needs to be very careful how much leverage that you're taking. So when I enter based on the ratio, right, or even before I enter in, what I usually see is what is the spot vol correlation of that particular stock. I just try to have a view on what's going on with the spot vol correlation. When I say spot vol correlation, it's not really correlation. It's if the vol is increasing when the spot is moving down, or if the vol is increasing when the spot is moving up. That's all the information I need. Based on this, I choose which strike to enter. For example, let's maybe just one which I okay, yeah, let's say Vsoft, right? For example, Vsoft, yeah, we have Vsoft here. So Vsoft is, for example, 269. I think I entered this for the March expiry. I think even last one, a week before expiry, March expiry. I remember the spot vol correlation was positive. I mean, it was going up and the vols were increasing. So, for example, if this flags up in my report saying that, okay, this has a very high VRP and now I want to short this, right? Now, this is fairly close to 270, so there is not much of a decision to make. I'll just enter a 270 straddle. But let's say if this were somewhere around 267.5, for example, right? And then now I need to make a choice between whether I do a 265 straddle or 270 straddle, okay? Or 265 call, 270 put, right? To make it delta neutral. So if the spot vol correlation is negative, so as soon as it falls a little bit down and vols literally blew up, then I will choose 265 as the strike. Why? Because choosing a 265 strike when the spot is at 267.5, the call is in the money and the put is OTM. So given that a little fall in Bsoft is increasing the vols massively compared to when it is going up, I want to hedge hedge against the Vega. So vol, if you enter a straddle, you're short vol, right? So the Vega is negative. So any increase in vol is going to give you a negative PNL. So Vega is negative, and then the vol has gone up, so you're going to make a loss. I want to hedge against this potential Vega PNL by a short delta. So if you short a 265 straddle, your overall delta is going to be short because your call is in the money, put is out of the money, so and you're shorting an in the money call. The net delta is going to be negative. So even if it comes down, your delta is going to help a little bit against any Vega losses. So that's how I choose the strike. And on the other hand, if it keeps going up and walls go up, then I choose 270 as a strike because 270 will have put as in the money. And so you're shorting that, so your delta is positive. Net delta is positive, so your delta again is going to protect against any Vega losses. So this is how I sort of tend to check, tend to look at spot vol correlation and decide my strikes. Even when it comes to adjusting, or even when entering further lots. Okay, I already entered one lot of straddle, and then I wait, and then I'm entering another, and again stuff keeps coming down. For example, the adjustments that I make are also based on the spot vol correlation. So, for example, uh, B soft is at 269, right? So let's say I entered 270, and B soft keeps falling, but there's not much noticeable change in wall. So I'm not going to adjust anything at all. But the wall keeps increasing significantly with any down move in B soft. I'm going to square off the 270 call. I'm going to bring it to 265 call. That's what I do. One thing to notice, it's always important to not to make too many delta adjustments. The more, I mean, if you know things keep moving, keep oscillating up and down, and you keep on making delta adjustments, you're gonna literally you're gonna blow up your account. I mean, even if you're trading like indices, for example, and let's say you're trading monthly straddles, and you keep on adjusting let's say Bank Nifty for every 200 points or 100 points, you keep on adjusting the straddles, you're gonna lose a lot of money. Because at the end of the day, the cost of delta hedging comes from the decrease in time value of the options, which is theta. Obviously, there's also a Vega component, but to sort of completely simplify it, your cost of delta hedging comes from theta. So you sort of keep on, if you're trading monthly straddles, your theta is it's not going to be significant, and you keep on adjusting, you're going to lose a lot of money. So you will end up in situations where your delta is not really neutral. So, for example, even now, if I enter 270, it's not really delta neutral, right? That is fine. I do keep, I sort of have a little tolerance on the delta. I definitely don't keep it zero. And then depending on how the wall is moving, I keep adjusting the strategy. I keep it till the ratio keeps coming down. So if it was 1.3 when I entered, it comes down to 1.1, for example. That's when I exit. You can also have a target on your profit. You can have a profit target, and then after which you can exit. Quite a few stocks. I think what was that? Lupin. I think Lupin, for example, I think it made a 4%. This one, right? Yeah. On this day, for example, the spot vol correlation was massively positive. It was very highly positive. And so the way I adjusted here is I think I had something like a 650 call, 650 straddle, and then I exited the 650 put and entered 660 put. And I didn't exit the 650 call. And then the walls were going up mad, so I just entered the 671. And then yeah, I think it actually even came down quite a bit. That's that same day. It made a massive move that day. So yeah, and generally speaking, whenever any underlying moves quite a bit in any one single direction. Vols tend to increase because whoever would have shorted on that particular side, whoever were, let's say, stock is going up, whoever would have shorted 60 calls, etc., they would try to exit much faster than people who would want to buy it. So that's how your vols tend to increase whenever there is a big move.
Okay.
And there's
Couple of
one yeah. So yeah, cool.
couple of
Any questions? Yeah.
Yeah, a couple of questions, I think. So, and let me reset the stage a little. So there have been a questions key, what have been the interest rate, dividend yields? I don't think we're going to take those things because those are very statically available. I'm sure you can reach out to Kranti or me, or, there are many other traders who can answer some of those operational questions. And this Excel sheet might also be sometime made available. So we'll not take those. But there are two questions which are of interest here to me. I'm going to speak those up, both of them. So first question is that what are some pitfalls of using realized volatility or the historical realized volatility as an estimate of the future realized volatility? That's the first question. Like, what are your thoughts? Any pitfalls? Any advantages on that? And the
Yeah.
other is there any advantage? So you talked about how when you're adjusting these deltas, you're rolling the strikes, right? You're exiting one call and put and then rolling into another one. So that's how you're delta hedging, but delta hedging can also be done by trading in the underlying stocks or futures. So if there's any benefit or advantage or disadvantage of one choice over the another. So these are the two questions I find interesting and would love to hear your thoughts.
Okay. The first one was on realized vol, right? I think the classic case would be Ambuja Cement and what was that? I think it was Ambuja and also I think Adani Enterprises. That was in September. I think when there was this news about I think Adani having a stake on Ambuja. I think that was one. I think I even tweeted something that particular month. So now, okay, actually that's a little bit different. But let me actually, now that I actually thought of that, let me explain that as well. The VRP in that instance kept on increasing from 1.5 to 2.2. 2.2 is an extremely high number, and these are like we're talking extremely liquid stocks, right? I mean, those are extremely liquid. Ambuja and all. I haven't traded Ambuja since quite a while, so I don't know how the liquid it is now. But they're actually extremely liquid stocks, and the VRP kept on rising from all the way from 1.4 to 2.3, and I at some point I just booked the loss and I just exited. I stopped adjusting. So typically, when there is news in stocks, I think it's always it's always better to try not to short the ball on those stocks because these can trend hugely. I mean, as a general rule, I think anything that is trending, doing a short, it's absolutely advised not to do short wall on any stock that is trending. Now, one might say that I have been trading Adani big time since February. Thanks to Gaurav again. I mean, he's the one who 31st of Jan, the weekend before that, he's the one who sort of who took these massive positions and got me into it. But anyway, it's a fantastic experience. I mean, overall, I made a loss in Adani in February, but that was the best loss ever because I learned a lot. I think when there are stocks which there is a constant news flow, there is a way to trade them if the walls are over 100%. So I before Adani, I never traded any stock which had an IV of over 100%. Never, and obviously never traded during COVID. So I always wanted to want to get this into my arsenal. How would I manage if short wall positions if something were to blow up? And Adani gave me that fantastic experience. So if there is a constant news flow and the IVs are over 100%, what I realized, especially in case of something like Adani. I mean, this plot is basically inspired by Adani. So I mean, you can enter straddles. You can enter straddles. So what, for example, a stock like Adani did is it is either going to stay there or it's going to move massively, like 8 to 9% either ways. So having like a shorting a straddle and then on the tails having a 3:1 back spread. That I did that in February, and that sort of it's not gonna give you profit if if you enter this position and the next day there is like a 9% down move or up move. It's not going to give you a profit, but it's certainly going to reduce the losses if you have this 1:3 back spread on the tails. And if it doesn't move at all, you can expect the walls to come down significantly, the eyes to come down significantly. So your straddle is going to expected to give much more profit than a little loss that you're going to make on the back spread, -3 back spread. So there's a way to trade these news flows. Coming to the realized vol question, right? So, I mean, in the same case, right, Ambuja, um, the realized vol absolutely wasn't a good measure of the future realized vol at all. What was being shown is and what's actually happening was much higher. So yeah, usually when there is news flow, then your realized vol is not going to help you much as an indicator. It's a pretty bad indicator. Let me put it that way. Um, there's one more thing that you need to see. For example, you have earnings, right? I'm going to come back. I'm going to come to earnings later on. You take earnings short straddle. Okay, not sorry. Let's say you have earnings on a particular stock, right? Let's say TCS, which will probably happen in like 10 days time or a week's time. Now you are, let's say TCS result is on 11th of April. Now you have moved forward, you are on 30th of April, or let's say you're on 25th of April. Now when you're computing your realized vol, you're going to take this period where there was this earnings moves. That is going to inflate your realized vol. The moves that happen during earnings probably are not relevant to you when you're looking ahead 20 days. I mean, once the earnings are done, your future realized vol is probably going to be much lower than what your current realized vol is showing, because the current realized vol has those earnings moves, the large earnings moves, right? So one needs to adjust the realized vol for those. Probably just remove that period, maybe just exclude the earnings period completely. And I have been trying to do that. I still haven't come up with a proper methodology for that. But yeah, the realized vol, you need to look at these aspects, not including a phase where there have been like wild moves. Also, even in terms of news, there is a news on a stock, let's say Z, for example, right? So after the news flow is done, your realized vol will still be pretty high because there were massive moves. And so your VRP is going to be much lower. It will be 0.7 or 0.8, which will say that, okay, don't short this straddle, but actually shorting it might be good because the future expected realized vol is going to be much lower than what happened in the past. So these are the considerations that you need to keep in mind when using realized vol.
Great.
What was the other question?
No, I think you answered. The other question was whether when you're hedging the deltas, you are changing the option positions, rolling the strike. Is there any benefit or disadvantage of using the underlying stock or futures to hedge out the deltas?
The thing with using the linear positions, right? I mean, see, I think first thing is you need to be So when I do this, for example, when I adjust my strategy, right, I do not look at my actual delta values. I have a very good intuition of what the delta might be. I mean, obviously, if you are going to trade short straddle on bunch of stocks heavily, you're going to have a very good intuition of delta. I mean, for a short ball trader, delta is the major risk that you want to stay away from, right? So I have a good intuition of what the delta is. But if you start getting into futures, then you absolutely better be sure what your delta of your the straddle position is. If it is going completely away from your straddle strikes. Um, I would definitely not recommend getting into any linear positions if we're. I think it's also probably going to mess up your thought process of how you trade vol if you start getting into futures. So I haven't tried. I'm probably not going to try as well.
Okay. Do you mind taking a couple of more questions, or do you want to go on? I think there are some interesting questions.
Let me just finish this, right?
Okay.
So
Let's hold the questions.
adjustment is what I do. Look at spot vol correlation. So at the end of the day, your delta. I mean, whenever you short straddle, etc., you're always going to get hit by. Okay, so delta you can use it to your benefit if you see, as I gave the example of piece off. If you think that if it is coming down, vol is increasing, you can accordingly take a strike where delta is going to be of benefit for you. Um, because the guy is probably going to give you a loss. So at the beginning of the month, it's a game between delta and theta, delta, gamma, and theta. Actually, gamma as well, but roughly speaking, it's between delta and theta. Delta and vega. Um, so as long as your delta is under a specific, band, the wall comes down, right? The whole logic of this BRP thing is you expect the implied wall to move closer to your realized wall, right? Um, so you're going to gain from Vega if the ball comes down. And as you move closer to your expiry, then your theta is going to come into picture. Theta is always our friend uh, for short ball traders. I think that's the most popular Greek in Indian fin rate. But yeah, so yeah, at the beginning of the month, it's mostly you need to the Vega thing, and then as closer to expiry, it's theta. Yeah, I think people can ask more questions. This is I think as I showed in the Excel sheet, this basically what it is. I'll get to relationship splits after that. Yeah, questions.
Just two more questions. So one is around the spot vol correlation. So somebody was asking, do you look at only while the entry, or do you keep on looking at it during the course of the trade? And the other question on spot vol correlation was, what kind of lookbacks do you use for it? Is there any stickiness that you find in regimes that the recent spot vol correlations tend to stay sticky in time? So any kind of insights on that is what I think people are asking.
In terms of stickiness, um, there are definitely stocks which uh, have the stickiness till, let's say, okay. First thing is the positional, the option positions, the short wall positions on the straddles. I tend not to keep more than 4 days. Sometimes it does go to a week or so, but if it's like liquid illiquid stock, then I tend to keep it for longer. If it's a liquid stock, I tend to not keep it for more than 4 to 5 days. Stickiness can go on till like for a couple of days, and for I haven't seen a lot of many stocks which let's say the spot vol correlation is positive, that tends to stay the same for 4 to 5 days. And I've seen the stickiness most of the times the stickiness dies within a day. So there is a big move up move, for example, and then your spot vol correlation is very positive, like it happened with Lupin. But I mean, yeah. So for that particular stock, for example, intraday it also came down. And when after a point, the spot vol correlation actually turned negative. Um, so, and Adani is a classic example when the spot vol correlation changes sign intraday consistently within the same day, within like few minutes, within like half an hour. The, the spot vol correlation changes sign. Yeah, it's mad. Okay, I think,
And I think one more question was, maybe you will talk about it. I just want to bring it up. When or how do you think about stop loss on these, or basically how do you think about exiting these trades? Is it about the ratio that may come down, or
is a
do
ratio.
you have like,
Ratio 1.1, for example, yeah, 1.4 is when I entered, and then uh, 1.1, or if it's a pretty liquid. So, for example, I enter even into stuff like Bajaj Finance, everything, Reliance. In these stocks, one needs to be very careful in terms of how long one stays in the position. These can, I mean, especially when it comes to when it comes to large cap stocks, I tend not to keep for more than a couple of days, 3 days max, because let's say Reliance has been falling, for example, it hasn't been falling the other day, but let's say it is falling, and then the walls have gone up. You enter. There might be some mutual fund or something. So there might be fund flows, and they'll probably think it is a good price to buy, and then you're going to probably get hit by delta more often than not if you keep it for longer time. So I didn't exit them as soon as, let's say, from 1.4 to 1.2, exit them, or I have a profit target in mind, and then as soon as it is done, I exit. By the way, speaking in terms of returns, I mean, I think there's some people who, like, if you see in terms of returns, for example, how much margin that you need to post for, shorting a straddle on, let's say, any stock. For example, Bandhan Bank, for example. Bandhan Bank, the margin is probably 2 lakhs, I think, for a straddle. And mid of March, Bandhan Bank went down from 225 to even came down to 199. The walls kept on increasing on its down move. You could, the walls can fall down intraday, and you can make as much as 4 to 5% intraday on just that particular strategy. So typically your returns can be extremely pretty high on stocks. But again, obviously, I know people tend to get scared about stocks. But yeah, the returns are pretty high. The risks are also pretty high. So uh,
right?
yeah, so yeah, I have a profit target, or I see if the ratio has come down to a certain level.
Great. I think we can continue. There are a few more questions, but we'll keep them for the little later on. So let's continue with the topic.
So I think ratio spreads. I think in my so I mean the ratio spreads. You can also do it in stocks, by the way. Although I haven't been doing it on stocks of late, mostly because of the bandwidth. I don't have much bandwidth to sort of. I have been trying to research other stuff as well, so I didn't get enough time. But there are good opportunities in ratio spreads in stocks as well. But I mostly do it in indices now. The best sort of example I can give is whenever any index, Bank Nifty is the one which I do mostly as far as indices are concerned. Bank Nifty is falling, and your walls go up quite a bit. Taking a call ratio spread, it could be a weekly option or it could be a monthly option. That can be a pretty profitable trade. So typically what would happen is, let's say bank is at 40,500 and there's a cap down of 1%, for example. So it goes to 40,000. So, and if you're trading weekly, so let's say you're on a Monday, right? Let's say there are no holidays. You go, it's 40,000. You can look at 40,500 and 41,000 as a 1:2 ratio, for example. Um, or if you're looking at monthly, you can go 41,000 and 42,000, 1:2, 1:2.5. You can make it as a credit ratio. So the idea of it, okay, when you trade vol, a good way to look at all of these trades, whatever I explained, is when someone is trying to exit stuff, right? Desperately, someone is trying to desperately exit stuff. So if there is a gap down in Bank Nifty, people who would have shorted puts, right? They would probably want to short more calls or maybe in the money calls, for example, to hedge their in the money short put positions. Now, obviously, there is not an unlimited margin, for example. So they might be exiting their calls somewhere at 41,000, for example, if you're talking of monthly, 41,000, 42,000, whatever. So that's where this sort of skew tends to appear. The call skew tends to be more pronounced. So your far OTM implied vol tends to be go higher than your near OTM option. When the market is normal, typically this is negative. I'm not talking about the extreme tail when it again goes positive, but a region where if it is at 40,500, you're looking at 41,000 and till 41,500. It's usually negative. It's negative sloping, downward sloping. But whenever things go, whenever there's a gap down, for example, the skew tends to be positive. So the IV difference, the short strike IV minus the long strike IV tends to be positive. That's like a signal for you to enter a call ratio spread. So you go long, for example, 40,500, and then you twice the quantity short 41,000. Now the profit, that sort of your profit comes mostly. This is a short wall position at the end of it. This is a short wall and this is a short skew position. And if the market after the gap down, even if it stays there or if it recovers slightly, then the position makes a profit because the walls typically or after recovery tend to go down, and you're going to earn through the Vega PNL. So it's a short wall, your Vega is negative, and then the walls come down. The wall and also the positive skew tends to get negative once there is a recovery. So you tend to make more from the short. The Vega PNL that you make is much more on the short side. The long leg, your long Vega, right? So that's going to give a loss, but you're going to make much more on the short options. So that's the trade. I think I spoke at length during the Jainam talk, so I'll probably not speak a lot on this. But yeah, I mean, so Vanna and Sham, I think there's something probably some of them wanted me to discuss. Okay, without me being extremely boring. I mean, one of the reasons I said that you should all have an Excel sheet with these basic functions is to actually make plots of these kind of things. You keep changing your spot and see how your option price are moving with increased vols, etc., and decreasing maturity. And Vanna is literally nothing but as you increase your vol, your options, they tend to get more meat. So what the green plot tends to become the yellow plot. So as you can see, This is the in the money option here. This we are looking at a put option here. The in the money option here, you can see the slope, which is the delta, that decreases for the in the money option, right? So the Vanna is negative. So the vol increases. The Vanna is negative for the in the money option. And for the OTM option, you can see the delta has increased. So the Vanna is positive for the OTM option. So ITM it's negative, OTM it's positive. Similarly, for charm as well, if you go more near the expiry, you tend to go more towards the payoff profile. So again, in this case, uh, the yellow one is with more time to maturity, green one is with less time to maturity. So as you can see, this is again a put option. So the OTM put, the delta keeps coming down, and then the delta of the in the money increases. So the charm of OTM is, I mean, it depends how you see. So as the maturity comes down, the delta decreases. On expiry day, I used to do a lot of put ratio spreads, and charm is the one which I focus on expiry day. So I have a long option which is closer to at the money, and I have a bunch of put options which are, let's say, 300 points away. Let's say I have a 1:3 ratio. The long leg is at the money, and short leg is, let's say, 300 points away, 1:3. And as you sort of go from 950, whatever, 920, 930, whatever, as you go near the expiry. So when you enter this is going to be a long delta, because you have shorted much more puts than you have long, so it's going to be a positive delta. But if the bank nifty or whatever does not crash, or it's almost stays in a range bound level, then it slowly tends to a negative delta position, which means that the OTM puts have reduced by quite a bit. So you will be making a profit, obviously, when your position goes delta neutral and tends towards delta negative. That's also when you need to adjust your short puts, maybe bring them higher, or just exit, book the profit. And if it is coming down, bank nifty is coming down, and the walls go up, then you're making a loss because your overall position is delta positive, bank nifty is coming down. So you need to bring your options, the short options down, or the whole structure down. That's how sort of you sort of tend to adjust on expiries. You can also sort of automate these things looking at delta. You can have a band on how much you want delta to be. If it is getting negative, then try to shift it up. If it's getting more and more positive, get the hell out of the position completely, because they must be, I mean, bank nifty is completely coming down. Maybe you just don't even want to be in the trade, or bring the whole structure down. So yeah, this is what Vanna is. I think Adani, I think pretty much, I think basically, uh, if there is a stock, as I said, that has a high implied vol, and it either moves a lot or literally stays there. So you can take an iron condor with a backstretch at the end. So whenever you take a straddle, you just short a straddle, your expectation is that your so this is the distribution of any stock or index. Probability density, this is the probability density function, and the area under this is the probability that the index returns are going to stay in between these levels. So when you take a straddle, your expectation is that you're going to be in this region. You're going to be in this region. If you are taking a ratio spread, typically you definitely don't want your index to be hitting the tails. You want it to be somewhere around this level, so that the long So typically, when I take ratio spreads, I don't take unless it is expiry. If it is, let's say, monthly call ratio spreads, I tend to keep my strike not ATM, but let's say away from ATM, and then my shorts are somewhere here. So this is the sweet spot for where I want the bank nifty to move or any stock to move. I
So
certainly don't want it to be here.
there was a question on this distribution earlier. Let me bring it up. So the question was that how are you drawing these bands? Are you looking? Is this just a example,
Pictorial
or
view.
have you looked at like the underlying and plotted the return distribution and then thinking about these cutoffs?
This is literally handwritten, and this is just to sort of have an idea of just to know what you're doing, right? I mean, if you're taking a ratio spread, at the end of the day, where what sort of returns expectation do you have in terms of where the bank nifty is going to end up? So I'm sort of trying to come up with a so if someone wants to actually do it in a perfect way, there is a model called SVI. It's an interpolation scheme, stochastic volatility inspired. So what one can do is take the bank nifty. Let's say take bank nifty April month end options across all the strikes. Yeah, take the implied walls, use this SVI scheme, and it's loosely speaking, it's like a quadratic equation of the walls in terms of the moneyness, and it has some parameters. Try to get those parameters by using these implied walls of bank nifty. Okay, so now that you got the parameters of this equation, SVI equation, now you can get the density. You can get the density simply by the butterflies. So let's say if you want to get the density at bank nifty at 41,500, 41,000, for example, right? So you take a very small butterfly around 41,000, let's say 41,000 and 41,050, 40,950. Take a very small space and you construct a butterfly, and the butterfly should give you the density function. Now you will ask, okay, we don't have um, uh, 41,050 strike, which is why you actually constructed the SVI parameter. From that SVI parameterization, now will give you implied wall at any strike that you want, at any strike. So you can get a very smooth distribution function. Okay. What you can also do, if you once you construct this, people do a lot of strangles on expiry days, right? On expiry day, okay. Okay. Let's say someone is doing straddles or strangles on monthly expiries, for example. You can take historical distribution as well. Okay, how did the bank nifty move in the past 1 year, 2 years, whatever? You can take a historical distribution as well, and you can plot the historical, like a density function. In historical density, which is very, you just take the histograms and plot it, and then you can also see this is what the distribution is implying, right? In terms of the probability that bank nifty will, you know, be in this green, in this red region or whatever. And then you also know historically what was the probability that bank nifty ended in this, region or over 2% within 1 week. What was the probability? So that can also give you a decent idea whether you should be selling strangles in such an environment. I mean, what I'm effectively saying is just try to compute probabilities using what your options are implying, and then look at historically, um, like what is the probability that bank nifty is going to go over 2% in, let's say, 2 days, and then accordingly uh, adjust your positions of your strangles.
Okay.
By the way, I think most of the guys probably know that probability of, let's say, bank nifty or nifty ending over 41,000 is ND2. ND2 should give you that probability. If that should be a rough approximation, and you can get a probability using ND2, and you can say historically what was the probability, and then if your ND2 is more than what the historical probability is, maybe you get more confidence in adding more strangles, more size.
There was another question when you talked about short volatility and long volatility trades. So there was a question: is there a filter or a mechanism which will make you switch from a short wall to a long wall, or vice versa? Or essentially, how can somebody think about it?
Switching from short wall to long wall. So as far as long wall is concerned, I only ever enter depending on looking at the ratios. So I just cannot imagine. I have entered a short wall trade that was, let's say the ratio was 1.4, and then I'm changing it to long wall because it has come down to 0.8. I mean, I can't see a scenario where I'm going to flip my position.
Okay. There is another question, and this is a little longer, so please bear with me. So the question is, if I have a short wall view for a holding horizon of 30 days, and then they list off 5 options on what could be done. So they are saying, given that they have a short wall view for a 30-day horizon, what will you do? Will you short wall naked on a 30 delta, 30 days to expiry chain? That's A. B is, will you short wall via non-directional spreads like 1:1 on a 30 DT chain? Third, short wall via directional spreads, wherein your M and N ratios are not same, again on a 30 DT chain, or short wall on a 45/60 day to expiry, so little further out, and close after the 30 days. So basically kind of a forward volatility and then closing down to 30 days or something else. So, let's just reiterating, you have a short wall 30-day view. How can you express it? What kind of structures can be put to trade such a view?
So I still haven't tried calendars. Very little. That is something that an area that is something I need to explore. Trading calendars. The one thing about calendars is you need to look at the actual Vega numbers of your next. So when it comes to stocks, the problem with calendars when it comes to stocks is unless you're looking at your Reliance, your Wipro, the next month strategies are not going to be liquid. So entering them. So if you want to long them and short your um, near month expiry, that's going to be a problem because there's no liquidity. But one good trade can be if you're in the last week of expiry in stocks. Shorting, this is literally no point. Longing, and if you think the walls are high, you can short the near expiry straddle, and you can long the next month strangle. Now, how far are you going to take the strangle strikes away from the money? That is something I haven't looked at. But one thing you definitely want to see is the Vega of the Vega of the next month expiry of the strangle, and you look at the Vega of so basically what can potentially happen is you might think that your wall term structure is sloping downward sloping, obviously, but it's too steep, and you expect that the near expiry walls are going to come down much. But you need to make sure you just need to make sure that you might make a profit in your near expiry straddle, but you don't lose much on the next expiry strangle because the walls there have also come down a little. So for the next month ones, because the Vega numbers are going to be higher, right? So all it needs is a little change in wall. It doesn't have to be anywhere near what your current expiry wall is, change in current expiry wall is, for you to make a loss. So calendars haven't traded. That's something I need to check. Now, in terms of whether you want to trade a ratio spread as a short wall strategy or a short straddle, I would certainly go with a short straddle. That's where that's the gamma is the highest for the straddle. I would take I would like to take the maximum risk of uh, basically the theta. So when you look at, for example, you close at expiry, your bet is how much the premiums are going to come down, which is basically a theta, versus how much you're going to lose from the gamma times whatever the squared moves are. So I would definitely enter a straddle instead of a ratio spread. The ratio spread is a different. Your bet is different in terms of its spread, although it's a short wall trade. It has a slightly directional component as well. You would ideally want if you're shorting a call ratio, you would ideally want the index to slightly move up, ideally to your long leg of the ratio spread. So it's a little different. So I would definitely short the straddle.
Great. There are a few more questions, but I guess why don't you continue? We'll keep the questions for a little later on.
Okay, I'll just quickly cover earnings. So earnings, I don't look at ratios, etc. Okay, I do look at ratios. I do look at the ratios, but I only look at ratio to size up. Size up. If the ratio is pretty high, I tend to take more lots, and if the ratio is low, I only tend to take, let's say, just one lot, for example. And the way I trade earnings is you would start entering the short straddles after, if there are only 5 earnings, for example, right? The best time to enter is after 3:15, but again, if the stocks are not liquid, it's extremely hard to execute all short positions in 15 minutes time. I mean, it's going to run super fast. So you definitely should start post 3 o'clock. Um, and if there are more earnings, start much ahead. The idea is you need to try to enter in all the stocks. So we have like 200 odd, right? The idea of earnings is you cannot pick and choose what you want to enter. Um, the Within any earnings period, the expectation is that out of 200 stocks, there will be, let's say, 50 stocks which might blow up, and there might be like 150 stocks which will where you can capture that event vol premium. So overall, you're expected to make a positive return. But if you sort of pick and choose, you might actually end up choosing the ones which move big post earnings. So the idea is you have to enter all the stocks and exit the next day soon. As soon as you like possibly could, you just enter, because your bet is only till only for the earnings. You don't want to take any market risk or anything else. So exit ASAP or the next day. The other thing to keep in mind is, so what happened in February was a disaster. So the February earnings was an absolute disaster. As probably also spilled over from Adani, I think. Even after earnings, the walls haven't come down. Even if the stock literally didn't move post earnings, the walls still haven't come down. But that's a pretty rare instance. So usually, if the stock doesn't move post earnings, walls tend to drop, and it's better to exit. One thing one should definitely not do, and which I did, and also made losses due to that, is if a stock is trending post earnings, even if the VRP is still pretty high, do not enter a short wall position on that. Okay, so if you talk of, let's say, February earnings in February, right? So first month earnings is January, and then February the second month earnings. Usually, first month of earnings is, at least based on my experience of the last 1 year, has been profitable because you have an expiry, Jan expiry, and your decent chunk of your stocks expire around expiry. I mean, 2 weeks before expiry. So you benefit because of theta. When you come to the next month, the second month, most of the earnings are done by 10th, first 1.5 week, first 2 weeks of the second month. So it's a battle between your delta and vega, right? If it moves big, your delta is going to hit you, and or rather, okay, if you think of it in terms of you entered a delta neutral position, you can say gamma. Your gamma PNL, your gamma times whatever spot move that has gone up. So your gamma PNL is going to be pretty negative. You're not going to get much benefit from theta, and your vega might actually even increase after the big move. So you're going to get hit all in all directions. So if the stock is trending, I mean, it can trend much further. So absolutely get away, book your losses, and do not try to enter or adjust your shortfall positions. That's a big learning I made. I got hit in Industar big February. I got hit in Concord, Axis Bank. Yeah, so that's absolutely not a thing to do. Thing to keep. So that's one thing to keep in mind. I think if someone would have seen my thread on implied move, so there is an event before you, and what is the expected move? Now this is going to get very technical, so I'm not going to discuss much. Probably I'll just refer people to look at my thread on implied move. So there is a formula to get what is the expected implied move. So one can try to calculate that to size up how much, how many lots of strategies they want to enter. So if the implied move seems pretty less, let's say it's implying only the walls are implying 2% move, then maybe compared to let's say 5% move, maybe you just want to take one lot. So these sort of measures help you to size up. There is nothing accurate about them. I mean, whatever they imply probably is never going to happen, but they give you some measure to how much you want to size up. So yeah, and this is basically what I wanted to share.
So sure, if we have a couple of more questions to take. So somebody's asking, can you share your observations of trading skew with risk reversals and ratio spreads?
The risk reversal is this trade, right? Where you short your let's say your long call and short long ATM call and short ATM put, right? Equal minus. I think that's what the risk reversal is, right? I never traded that. I never traded. That's like it's not a delta neutral, right? So I never traded that. Ratio spread, as I said, my experience with the way I mentioned, look at if you're trading call ratio spreads, bank, there is a down move, for example, and your implied wall difference has gone positive, and you enter that. I think that's a fairly high sharp trade. I mean, you're not going to make as much returns as probably if you trade a straddle, for example. But I think the risk is relatively much less.
So, but in general, let's say if not these, but when somebody thinks about trading skew, any other pointers or thoughts that you might have with somebody who's probably starting out, trying to learn, can start looking into?
Okay, if someone wants to try, for example, right, I'll suggest look at all the stocks, right? For example, tomorrow, look at all the stocks and see if any stock has gone up by let's say more than 3% or gone down by more than 3%. Okay. Um, look if it has liquid option prices. Try to take if it goes down more than -3%. Try to take so we are now right now in April, beginning of April, right? You can probably take a very low quantity just for you to learn. So if any stock goes down by more than 3%, choose a strike, choose a long strike. So we are talking about call ratio spreads here. Okay. Always remember that the ratio spreads, be it call or put, you are going with the trend. So the stock is going down, right? And your call ratio spread is net negative delta. So your delta should be in line with where your stock is moving. So anything moves more than 3%, try to enter a ratio spread where you choose the long leg, which is 5% away from previous day close, and the short leg is further 5% away from the long leg. Try to make it like a 1:2. Try to make it like a zero, uh, zero cost ratio spread. So whatever you're receiving from the short leg is compensating for whatever you're paying on the long leg. You can try that. Okay, actually, before trying that, also try to open, let's say, a sensible or whatever you want to open. Look at that stock and check the strikes that I've just mentioned, right? 5% away from previous close and 10% away from previous close. And look at the implied vol difference between these two. If the implied vol difference is anywhere above uh, 3 vol points, let's say 35% is the 10% away from yesterday's close, and 32% is 5% away from yesterday. So you can enter the zero cost credit ratio spread. Sorry, zero cost ratio spread, call ratio spread on that.
Okay, great. So there are a few more questions. While some of them are not really, I wouldn't say not relevant, but they are not too specific to the talk that we've been having. But I'll just say it out for the sake of completeness, and then you can choose which ones do you want to take on or not. So first question to take is somebody saying, if we skew, if we in options, if we see skew, wherein let's say ATM plus 4 strikes IV is 23 and ATM plus 6 further out is 25, can we not take debit ratio as your downside is limited, and if the spot moves up we will make money? So I think they're just talking about the skew in a way, but without any underlying signal. That's one question. The other question is, you have your expiry day ratio trades. Do you keep them debit or credit?
So expiry
And
trade.
the third question is, please go ahead. I'll take the third question later.
Yeah. So I think the first question is whether you, instead of doing it a ratio, just buy a debit spread, just a call spread, right? Okay. Now again, the expectation is you have a solid expectation that your stock or index is going to go up, right? That is something as I said, I don't know anything about the spot moves. I'm pretty bad at forecasting where the underlying is going to move. So if you are going to buy a debit spread, your expectation very clearly, more than anything to do with vol or skew anything, your primary bet is on the spot going up. So you have a delta and you want your spot, you have a positive delta and you want your spot to go up. That's the primary bet here. And I have zero clue about how estimating, forecasting spot moves. So one thing I would definitely add is, if a stock, for example, has fallen by, if it has hit a lower circuit, let's say there is not like a really bad news where there is a corporate governance issue or um, probably even change in MD or CEO. If let's say the results, I don't know how to actually put it, but if let's say the stock falls for not a very severely negative news, there is a tendency for the stocks to recover. That's probably because, again, funds might think there's the right place to buy, so buying. And this typically happens with large cap stocks. So the debit spread might, I mean, the call spread might be a good idea to take for large cap stocks which have fallen significantly, but there is not like a very bad negative news. I remember, I think with Lal Path Labs, I think that was in, it's probably November earnings. It hit a lower circuit. I think it further probably fell like 2% after the next day. And then it hit a 7% up. I got hit. I thought once it hit the lower circuit, the walls looked good to me. I entered a short straddle, but I got hit by the upside move. So yeah, I mean, stocks, when they go down, they tend to sort of revert. Not necessarily the case when they go up. If they go up, they probably tend to go up. There is an asymmetry as far as stocks are concerned. The call spread might be good for stocks, especially the large cap ones. And then your next question was on expiry day ratios, right?
Expiry day, yeah, spreads being
Yeah.
negative premium or positive premium. So
mostly I'm going to keep it as zero cost or credit. Zero cost or credit, unless yeah, I think on expiry I'm going to keep it zero cost or credit. Yes.
And what about the exit is what the question also asked.
So delta, so I mean, on expiry day, I'm just looking for the charm effect, right? So I'm just going to wait, right? So and unless the exotic put ratio spread and oh, by the way, let me just make it clear. This implied vol difference that I talked about being positive, enter when it's positive, that's only for call ratio spreads. If you look at put ratio spreads, it's the implied vol difference is always positive. The put skew, if you see, is always upward sloping. So the what I mentioned as a signal is only for call ratio spreads. So put ratio spreads, if let's say on Bank Nifty, if it keeps coming down, I'm going to push the whole structure downwards, booking a loss. That's going to definitely be a loss. And once Bank Nifty settles, I'm going to just keep hold of it. And my adjustment is going to be based on delta. So let's say I entered the put ratio spread and Bank Nifty keeps going up. Okay. Now the long option, so let's say I entered a zero cost. So the long put is going to, you'll end up in a situation where the long put is going to decrease much more in value than the short puts are going to decrease. So you'll probably see an MTM loss on those. So in that particular case, I would push my the long put. I'll push up the strikes, and I'll start shorting more puts. I'll start shorting. I'll basically push up the short strikes as well. I'll probably keep the existing structure, but I'll enter probably a new structure, shorting a higher put strike. Going long a higher put strike and shorting higher put strikes. So basically, I'll just push the whole structure up. So my bet here is that I don't want the delta to be. I want the delta to be in a specific band close to zero. Right, that's basically what I would like to put, and then I'm just going to keep waiting. It's probably not clear now, but yeah, I mean, if it comes, if you're, let's say, entered in the morning and then it's at 2:00, and then Bank Nifty hasn't moved much, your delta is definitely going to be negative now because the OTM puts have gone down by so much. The delta on them is pretty negligible compared to your long put, so the delta is going to be negative. So in this circumstance, I'm going to push the short puts up so that I can again make it delta neutral. So the adjustment is going to be based on delta, the net delta.
Okay, great. There was a comment on interest in looking at your scenario analysis sheet, which I think is also on the screen right now. Probably people want to see what kind of scenario analysis you run or How could they replicate it? So if you are comfortable sharing, I think that will be useful for the audience as well.
So, I mean, as I said, I mean, I sort of have this sheet where I have the implied vol is just simply based on your Newton-Raphson method. I have my black delta, black vega. So basically, I mean, I think all you need is the Black-Scholes formula, the implied vol, the black delta, black gamma, black vega. These are pretty much enough. And then, I mean, you can sort of. I definitely don't want to probably show a lot of. I mean, I think we can probably have another maybe thing some other time, and maybe I'll show
Sure.
different.
It might be.
So, but yeah, I mean, in terms of the scenarios, right? For example, I think this is something pretty old now. I don't know when. Okay, this was in. Oh wow, this was like 1 year ago. Right, fantastic. So I mean, yeah, you can have your T-1. So for example, if you're entering a straddle, right? Entering a straddle on Bank Nifty weekly, for example. So just put whatever quantities you have and whatever the price is right now. And then you have your, and then tomorrow you can create different scenarios. What do you expect the implied vols to be, for example? And depending on that, you can use a Black's formula to compute your new call and put prices, and then you can check how much PNL you're gonna make or lose. And you also have theta. When it comes to theta, I mean, keep in mind the way you should compute theta is you keep everything else the same. So you keep the spot the same, the vol the same. Yeah, and then you only change your time to expiry. You keep bringing down your time to expiry. So if you're doing a scenario analysis, you have taken a straddle, for example, yesterday evening, and you want to check tomorrow morning. So I check in terms of hours, number of hours reduced. So you know how many less hours now you have to expiry, and based on that, you compute your Black's formula. So if you have a call option, for example, you compute your Black's formula using the same implied vol as of yesterday evening, but with the new time to expiry, right? That should give you the theta. So what it was yesterday evening, the call price, and what you're going to get with this new Black's formula with the new time to expiry. That's a new call value. So the difference in the call price should give you the theta. That's the theta PNL for that particular call option. Yeah, so you can do different scenario analysis on your whatever positions you have. You can also, for example, do stress testing. So, for example, if your trading expiry strangles and Nifty suddenly goes down by 3%, for example, you can assume how much the vols will go up by, for example, and you can use these functions, and you can calculate where your puts how much might be your put prices, and you can see how much loss you're making, for example, and accordingly you can adjust your positions.
Great. Couple of more questions. So first question is, you talked about distributions and how butterflies can be used as implied probability distributions earlier in the stock, right? So if you have any experience or thoughts about using them in any of these analysis, is there any any kind of benefit in using those implied probability distributions in volatility trading. Understandably, the IPD kind of refers to the underlying expiring, the probability distribution of the underlying at the expiry. But from a vol trading perspective, if there's any use case of using the implied distributions.
So as I said, I haven't used it till now. I think at the beginning of this webinar, I think I mentioned, right. I'm still sort of getting acquainted to the whole trading thing. So I'm learning stuff as far as trading is concerned. And eventually, I'll start to bring in my sort of quantitative knowledge. So make my strategies, make all my strategies pretty rigorous in terms of the quantitative knowledge I got. But as of now, I haven't used the distribution function
Okay.
to look at. But as I said, one of the things I have in mind is look at the historical distribution. Let's take a very simple example, right? For example, daily option. You enter it, let's say, straddle on a Monday, it expires on Thursday. So you have like Tuesday, 3 days, 3 days, right? So starting from Monday, it's going to be like close to 4 days, right? Whatever that is. You can take, for example, what has been the if you are an intraday trader, your life of the trade is only from, let's say, morning to evening, right? So what you can probably do is you can take the 1 day returns. You can take the open to close returns of, let's say, Nifty or Bank Nifty. I mean the historical returns, and then you get a historical distribution. And then okay, now the question is here, because we're on a Monday. If you draw your probability distribution function, that will tell you that will give you the probabilities for the next 4 days. So I think the better example would be take the expiry day. If you take the expiry day, whatever your distribution implied probability distribution function is going to be for that day, and you have the historical distribution of what Nifty or Bank Nifty did from open to close historically, and that should give you a sense of whether if you so what could potentially happen is, so you have this distribution, right? What could potentially happen? Your historical distribution might have a fat tails, for example, right? It might have fat tails and less area in this region and more fat tails here. That might tell you maybe if you're doing strangles, strangles are basically you're betting that there won't be a tail event, right? Or there won't be bigger moves. So maybe if that happens, maybe you want to reduce your strangle positions, right? And let's say I mean, if let's say the historical distribution is let's say is more mass in the between than the tails, maybe it might say that, okay, go ahead with shorting straddles. There might be more. That might be a decent bet. So that is one way to look at implied distribution versus your historical distributions.
Okay, thank you. One question, it's probably referring to one of your threads, but it says, I'm just going to read it out. It says there was a thread about Black-Scholes delta and modified delta. So modified delta, they are talking about as the Black-Scholes delta plus spot minus vol times vega. I'm assuming that's what the calculation is.
I think it was just a comment. Yeah.
Yeah. So they are saying the question is it really big enough to consider? Because example, modified delta being 0.4, whereas Black-Scholes delta is 0.5. Do you take this kind of modified delta into your analysis?
If you look at this thing, right? So when I trade straddles and I talk of spot vol correlation, indirectly, I'm bringing that into picture. So what? By the way, I haven't written any thread on that. I think it was just a comment I made. I think John Hull has a paper on coming up with a modified delta. So effectively, what you're saying is, let's say you take a call, for example. Your call option is obviously it's dependent on the implied vol and also your future, right? So what is your delta, right? Your derivative of your call is respect to your spot, but also you know that you have your dependence on the spot dependence on sigma as well. So sigma is actually also a function of, if you just consider sigma as a function of spot as well. Using basic calculus, you know that if you find a derivative of that with respect to spot, I wish I can actually write it on my screen, but so you have okay. Can I actually write it? Yeah. So you have this, right. So you have your sigma, which is a function of s, right, and then you have s. This is your call, right? If you're deriving finding a derivative of this with respect to s. So first is you have your standard delta, which is basically dc by ds, right? Right? And so you're first finding the derivative with respect to your second argument, this one, okay? And then you have this, and then you're gonna have the c, whatever this whole thing. I'm gonna not write it again. And then this is the first argument now, right? So your d sigma, right? And then you have your d sigma over ds, right? I think this is probably what it is. This is your modified delta, I think. Right. And so this is what the first thing is the delta that we all like, it's a black delta that we use. Now we have this additional factor here. So by actually looking at the spot vol correlation, right? So I mean, I'm some way bringing this into picture, that I'm trying to look at this dependency and accordingly changing the delta of my straddle. So I'm choosing, and the start delta, the initial delta of my straddle is dependent on looking at the spot vol correlation, which is effectively I'm trying to sort of bring this into somewhere into picture. So I'm not using it quantitatively, but qualitatively, this is sort of what I'm trying to do.
Okay. I think there are no more questions as such. So I know you've been speaking and delivering for two hours. It's a lot of content for somebody who's not well versed with some of these concepts to take and digest. So unless if you have any closing thoughts or suggestions for somebody, I think the audience, would be people who are probably trying to learn some of this stuff, or somewhere in the middle of their learning curve. They know something, they don't know some of it. At least I am there. So for such people, if you have any advice or any other closing thoughts, we'll take that, and then we'll probably close this call in a few minutes.
Okay, one thing on leverage, right? So when I was trading Adani ports on the 1st of Feb, when was the budget? Budget was on 1st of Feb, right? I think the second half of,
yes, I think second Feb.
Second Feb, okay. The second half of the budget day was an absolute mayhem, because I think that was when the FPO getting cancelled was probably in the market. I ended up having eight lots of straddles. Post budget, I expected the walls to further come down, so I entered most of it before Adani ports went mad. There was one particular straddle, which is the night straddle, which I have like two accounts. One is on XTS, the other one is 5 paisa XTS, which I'm struggling with. The other one is on Zerodha. One is nice straddle, which was taken in this other account. I made 45K loss within like 15 minutes in that particular straddle, just one lot. And what happened was, that was when Adani ports went down from I think 530 to 472 was I think the lowest circuit rate. From there, it sort of tried to recover. I exited the put option at 109, the call option. As soon as I exited the put option, the Adani ports started going up, and the call got exited at 72 something. It was an absolute disaster. What basically, when people, especially who trade on expiries, right? They take huge quantities of strangles and straddles. When things go absolutely mental, which happened with Adani Ports, people are desperately trying to exit. So what happened during the time is no one was, I was trying to exit my puts. No one was willing to sell, right? Exiting meaning obviously I was trying to buy. No one was exiting. No one was waiting, was ready to sell. When it comes to the calls, I was trying to short in the money calls to hedge my completely screwed up puts. But obviously, I also wanted to exit my book my profit in the calls, so get out of the calls and then short because I didn't want to be in the situation that it recovers and then I get hit on all the calls. But the market maker obviously would have looked at how many folks are trying to get out of the calls. So the bid ask spread was 10 rupees. So 42 and 52 and then 50 and 60, that was the bid ask spread. Adani Ports, I think, is 625, right? So 6,250 is literally you need to cross that to actually get out of your. What I'm what I'm trying to explain here is when things go absolutely mad, right? It's going to be extremely hard to exit your positions. You can end up in a scenario where it's going to be extremely hard to exit your positions, and the more quantities you have, I hear about people taking 1 lakh quantities in, let's say, Fin Nifty. I think the other Nikhil Kandal was telling me that someone was taking Fin Nifty 1 lakh quantities, or let's say 20,000 quantities. If shit were to hit the fan, people are going to struggle to exit these positions. Might find it difficult to exit these positions. Um, so, and you're probably not only going to blow up your bank account, probably even blow up your broker as well. So I'm sort of beware of leverage. Try to don't be too greedy to eat these peanut 2 rupees, 3 rupees uh, options and increase your quantity massively. That's the only thing I'm just going to say.
Yeah, I mean, you have said something which is not very popular on Twitter. People are the other side. So, and it's good to, coming from you who's experienced and can talk to the scientific side of the numerical side of these things. It's really, useful. I actually had one last question before we close out. And, this has nothing to do with the general talk. It's just a broader question. And, I have heard different opinions of different option traders. So, how much, and I get this a lot of times from my DMs or reading somebody else's tweet threads as well. People often ask how much technical depth or how much of technical know-how of multiple of Greeks is required to be trading profitably. And just being a caveat here, people trade profitably if they are shorting tails until the tail occurs. But let's say in a systematic, in a reliable manner, as a trader, where should somebody think about bringing their knowledge, or where can they kind of find that balance? Because not everybody has the kind of exposure and opportunities that somebody like you did, trading on a desk and trading interest rates, which are completely different beast. But somebody who,
By the way, I mean, just to sort of correct you, I wasn't trading interest rate. I was a quant pricing stuff.
okay, correction on my part
Yeah,
then.
yeah,
But nonetheless, your experience is very rich when it
yeah,
comes
definitely.
like
Yeah,
in an institutional standpoint, wherein even 1 basis points can make a difference here and there, right?
yeah.
So for people who are trading themselves, or let's say small or mid-sized books, uh, and they are willing to learn about, let's say, the quant aspects of these option tradings, where do they find the balance, or any other thoughts for the conundrum of not being complete, on being one side completely disassociated with Greeks, and on other side being very, very theoretically super strong in it, uh, and probably somewhere in the middle, right? So, your thoughts on that kind of
Yeah.
discussion, argument?
So I think one, especially at the beginning of their option journey, just have a intuition about delta. to be very honest. Don't focus much on Greeks at the beginning of your journey. Do not. You're gonna, once you start trading your straddles or whatever, you're gonna get an intuition of delta, even if you don't want to. When you see your losses in your account, I mean, you're gonna get taught everything. So I think there's no need to emphasize on Greeks at all. I mean, I would say not just beginners, even try to understand the market first. Try to understand the market. Try to understand the dynamics of how market makers sort of behavior of market makers, how do spot and vol, etc. I mean, just focus on how spot behavior, vol behavior. I mean, definitely try to have like an implied vol in front of you. I mean, use whatever you want, sensible or obstra, whatever. Just have what are the implied vol levels, and if you have realized vol levels, it's better as well. I mean, if someone who's struggling to compute realized vol, just try to get the close to close standard deviation, standard deviation. So as far as Greeks are concerned, I would say forget about Greeks if you're a beginner in options trading.
This is very much in line with something I've once heard from Ewan Sinclair, who's, everybody agrees to being a very, prominent option trader. And his example is like, think about an F1 car. The engineers or mechanics who are mechanical engineers who are building those cars or maintaining it, they need to know the working of a car in a different manner. And the F1 driver has to know it in a different manner. They are both talking about the engine, but the depth of knowledge that you need, the breadth and depth of knowledge is very different depending on who you are. So as a trader, what he says and what you kind of allude to as well, as a trader, we are kind of the F1 drivers. It's good to know, it's important to know, but then a mechanic who runs the engine and builds those engines are very different than the F1 traders. So pretty interesting thought, I would say. Kranti, it's been a pleasure hosting you on this, and I hope the audience would have received a lot of information from this. You might, maybe we can put your contact details on the screen. So that way, if somebody wants, I know people know you already practically in the Twitter space, but somebody who might come to this YouTube video. So if you can probably put the slide number 2 or 1 that you had on the space, so people who can want to reach out directly. So I know his Twitter handle is Musk, MUSKK, and he has a Substack. He just started posting on it, and of course the email. Any other thoughts? Otherwise, we'll end this discussion.
Thanks a lot for organizing. This is my first sort of webinar, giving Gyan, etc. Hopefully one on expiry trading. Who knows?
No, I'm sure there's a lot of little nuggets, and if later on we can think about expounding on one topic at a time, and thank you for your time, and I'm sure people found value. The quality of questions that came in based on the discussions that you were making actually talks about how discussion is not something more pedestrian, it's more involved, and it's thinking on some higher level, which is otherwise not really often talked about. So thank you, everybody. Thank you, everybody, for joining, who joined us on Zoom, who joined us on YouTube. These recordings will be available. The presentations, I'll try to host them sometime, but you can reach out to me otherwise. But thank you, everybody, for your time. Thank you, Kranti. Thanks a lot. And I hope to interact with you guys soon. Thank you.